So once again, good afternoon, ladies and gentlemen. Thank you again for the opportunity to interact with all of you today. So Vinay and I again are both looking forward to having this engagement with all of you on the call. And we would like to take this opportunity to review the outlook and the opportunities for Indian markets as we continue to progress through 2024. And also we are in the midst of a general election process, which is underway. More importantly, we shall cover the backdrop from a global macro perspective, and then we'll concentrate on the outlook for the domestic economy. And we will conclude by highlighting our longer term strategy from a portfolio perspective and our thoughts on how we should position for the same. So once again, please feel free to ask us any questions and hope you enjoy the presentation. So I think to set a backdrop, we are already now, into 2024. We are observing the global economy is at a bit of a crossroads. Clearly, there are a number of geopolitical risks, which also appear to be rising. And the global economy still does not seem to be positioned for a strong recovery. The US economy in particular appears to be showing some resilience, as quite a few data points regards employment and inflation are showing. Therefore, my first question to Vinay is, do you think a US recession is likely to be delayed, Vinay, in this backdrop?
Thanks a lot, Rakesh. Welcome everyone for this webinar. We hope to make this a monthly affair, and we really appreciate your time. Having said that, Rakesh, I think your question is something which we dwell virtually every day when we see the Indian and the US 2-year, 10-year chart. But let's just look at a snapshot or a cheat sheet out here. There was a time wherein somewhere in March, April, we expected interest rates to fall down. That expectation has now been delayed not by 1, not by 2, but by as much as 3 quarters. And the number of cuts also have reduced. So will we have interest rates cuts come down? Yes, it will. Question is when. And that's really the same answer as to, is US having a recession? The US GDP is growing far faster than expectation, and inflation's got, to sticky levels of 3.6. If inflation was at 3%, you would have seen rate cuts come up by now. And that would tell you that, US is going to get healthier in the time to come. The resilience is forcing the government to realize that, is there a huge slowdown coming in the future? Let me, quickly take you through why this problem was created, Rakesh. Right? If we were to look back when the interest rates moved up, to 5.25 to 5.5%, as far as the US Fed rate is concerned, that came after the US balance sheet kept on enhancing, which happened because during the COVID time, there was a lot of money spent. The fiscal deficit increased to substantial levels, and that number of the fiscal deficit, for India obviously being 8-9%, for US being 5-6%, in that point of time was as much as 14-15%, is still a high 6%. Right. What this has done is this has led to ballooning of the debt in US, and the real interest rates in a long period of time in US was negative. This finally now, as far as US is concerned, we are in the positive real interest rate, which is basically simply put, the Fed rate minus the inflation, so 5.5 minus 3.52% levels. That's a healthy number. And US is focused on doing that currently. And till inflation doesn't come down, you have an interest rate problem coming down. Just moving to the next level out here, if we see how the US interest rates have moved, right? The 2-year chart is at about 5%. The 10-year chart is 4.5. So the gap is a negative number, which kind of tells you there is something dramatically wrong. Is it a recession? Is it a slowdown? But whatever the problem is, it's not normal times, and the government of US has to solve these problems. Also, are they buying growth? If you look at the growth in debt versus the growth in GDP, apart from the first quarter of last year, for 3 consecutive quarters, the debt was more than the GDP. So clearly there is pain in US, which is coming up, and that pain in US is actually even more in the rest of the world, which now has a debt of north of $310 trillion. If you put it simply, Rakesh, when we look at companies in our perspective and look at a debt to EBITDA ratio of 3x, we get concerned.
Yes.
And out here, we are seeing the government, the US or the world together having a debt of 310 trillion and a GDP of 100 trillion. You divide the two, you're getting a 3x for the world. So the world is undergoing, a tough stance or a slowdown stance. And I genuinely think this is a big problem. But, before I get into more details on US and, how the layman there can get impacted, over to you again, Rakesh.
Yeah. No, so from that extent, just a few points, to set the tone and expand it a bit further. So clearly now the progression of Fed rates cuts, is being extended outwards into the future. So my first point would be, do you see this now moving more as a 2025 phenomenon or event? And then secondly, what are the key tailwinds and headwinds now you see developing for the remainder of the year? Another point I have is, you said that, obviously US is having a problem, but many parts of the world continue to have a problem. Do you see China providing any silver lining this year, perhaps in the second half of the year, for example? And, something that's been playing on a lot of people's mind is with this geopolitical tensions increasing in the Middle East. Are we vulnerable to another energy shock?
So, 3 questions. Let me take the first one first about US. Clearly, the pain in US is seen when we look at the mortgage applications now. They are lower than what they were in 1995 to 99 times. So that's not a great sign. Second, if I look at credit cards and how, the delinquency rates coming up out there, that number is as much as 5%. That's out here. If I look at the auto delinquencies, that number is as much as 2.53%. So everywhere, mortgages is, about give or take change 1%. Everywhere there is pain. It may look as a small number if accumulate everything, but clearly retail US is being questioned. The proof in this pain is more so when you look at the interest rate payments, which both the US government and, what US consumers are paying. As far as non-mortgage and mortgage are concerned, the consumers are paying as much as $600 odd billion, or about 2.5% of their overall savings each. So that means you're paying 600 in mortgage and 600 in non-mortgage. That's 1.2 trillion. And a similar number, around 1 trillion, is what the US government is paying in their fiscal deficit. That number is inched up from 600 billion last year, incrementally 400 billion, in line with the US debt and the interest rates of US gone up. So the fiscal deficit too is not going to is earlier, which was going into capex mode, is now going into the not so useful mode of payment, which is just paying in interest rates. That's not great. Now, to club up the pain, you're seeing a lot of delinquencies happen in multifamily housing. And that is like kind of telling us you're back to the 2012, 2013 pain point, which again is not a great sign.
Okay.
So I think these are the first parts of your question. Moving to the second part of your question, which is on oil shock. I'm going to cover, the oil shock part along with, what that means to India. So firstly, at 90 million barrels per day of overall consumption, the demand last year has been better, largely because EV is still not a substantial portion of it. 5 years forward, Rakesh, EV, green energy may make demand incrementally vanish or even come down in the energy space. But the problem which oil has is because not enough has been invested into the ground, the cost of getting oil from the ground, if you don't take them out this year, next year becomes twice as much. Okay. Right? And as that keeps on increasing, your price of getting oil out for 80 million barrels, today it's 90, may be the same as the price to take gas oil out at 90 million barrels. And that's where the oil price really goes up. And that, I think, is a concern. The concern becomes worse because, as you call it, black gold is available in countries where the geopolitical risk is a lot more. right? If you look at Russia today has 10 million barrels per day of oil. They consume only 5. There's 5 available from them. So can you, as a US citizen, consume it? Can Europe consume it? Or are there big words like sanction which come into the picture? Hence, companies like India or countries like India gain a lot on that part of it. So I think the world can have a shock. One of the key reasons, and our analyst Vinamra and we were just sitting here and discussing, can't interest rates start getting cut? Are people getting overheated up on interest rates now not going to fall? As against they got over clear that they're going to be 7 to 8 cuts earlier. Now they talk about no cuts. Is this both sides an exaggeration? Well, the answer may be in between, may not be totally an exaggeration because geopolitical risk is equal to oil price going up. People have not invested on oil, so an OPEC for them to keep 6-7 million barrels of oil at home or just cut it to keep the prices further up is another pain. EV not taking off the way which you wanted to is another pain point, be it green energy, solar, wind, whatever way you look at it, that's not replacing the normal oil or even gas. So technically, yes, oil shocks are part of life, as is geopolitical risk.
Sure.
And that's why you get sticky inflation, Rakesh.
Yes, yes.
India is a bit better, but I'll wait for that part of the comment.
Sure. But do you see a silver lining from China, Vinay?
Sorry, on the third question of yours for China, do you see a wish? I hope you could convert the question into wish. Earlier in 2007, 8 or 12, 13, when you had crisis, be it GFC or, Asian crisis, you had a big word called global deflator.
Right.
And that was China, right? They built ghost towns out there, and whatever they did it at such mammoth scales. Your pricing of your product was so much cheaper that the consumption, you could buy something at 1/3 the price, and the consumption started taking off very well. Today, you don't have a global deflator.
Okay.
And that is the importance in my eyes for China to do it. Having said that, just think of a scenario, and I'm just again going to take a bit of a discussion I was having with our economist Anirudh. This is the first time we are seeing Japan interest rate hikes. We are seeing China interest rate cuts. India and the rest of the world because of US not doing anything in interest rates. So aren't we covering all sides, right? So if you have somebody sitting in Japan, they're saying interest rates are going up. If you're somebody in China, interest rates are going down, and rest of the world interest rates are going nowhere. This is kind of mayhem, right? This is confusion galore. And I think you're in that situation wherein if China gets worse, your pain point of inflation coming down becomes a very big question mark. Or put simply, isn't the world going back to opposite of globalization? And Atmanirbhar in India is good, but isn't everybody saying that we are looking at whatever we want to do? That may not help the inflation story. So I think hope is a better word than will China come up. But when China comes back up, you'll see a lot of these problems probably getting solved. And I think it's important for the world to see, China's production come back up, China's consumption to come back up.
Got it. So Vinay, just to summarize before we move on to how India could stand out in all of this scenario, just as a brief synopsis, then what do you see as a few headwinds and tailwinds, that could play out for the remainder of the year?
So with 60 plus elections in the world, the biggest, I don't know whether geopolitical is a bigger risk or political is a bigger risk, but that's the big headwind. The second is, the Russia war is not yet solved with Ukraine, and you're fighting with another war. So you having too many wars, so that's the next big issue into the picture.
Right.
It's not the war which is creating a problem to the rest of the world, but the locals in terms of life and death. But what the war is doing is supply disruptions.
Right.
Think if you're a defense company or a chemical company and your products are coming from Europe or some other parts of the world, how will you get them into the country? And that number of days increase, cost increases, inflation increases, right? So the supply disruption. So that's the big second headwind.
Sure.
In terms of tailwinds, the easiest way to put it is interests are high for long, which means they can't go much higher. which means you're here, right? I hope you can't see my hand. And
Right.
technically,
Right.
it can only go one way. Now,
Okay.
typically, if you were to use, the simplest principle in finance, when you expect interest rates to go down, you expect cost of capital to go down, you expect cost of equity to be relatively down, you expect the markets to go up, right? So
Okay.
conceptually, you're at the worst point for funding, and better points will lead to cheaper cost of capital and should
Okay.
lead to much higher valued companies in the future. And that's why, you should be bullish the markets.
Okay.
I think that's the biggest headwind, biggest tailwind, which is, interest rates falling. But question is when.
When? Okay, Vinay. So now focusing a little bit more on India, Vinay. I'll break this up into two parts. I mean, obviously, India's market performance stood out fantastically over the last 1, 3, 5-year period. What were the major factors driving this? And having said that, in terms of looking a little bit forward, our election is already underway. We've just had a manifesto from the BJP that has come out that is focusing on responsible growth with fiscal prudence. And three key themes which stand out are infra, manufacturing, and capex, which appears to be significant pillars in this plan. So how do you see a continuation of how our markets have performed, and the way the economy seems to be moving? Do you see this continuing, going ahead as strong pillars for growth?
Sure. Thanks, Rakesh. Going for the first question of yours, and if I look at, why has India done well in the last 1 year, 3 years, 5 years, and there are multiple reasons, I think, where it's come. The biggest reason is in the last 5 years, fiscal prudence has been very good. The fiscal deficit as a percentage of GDP is inching down. The number 10% 5 years ago has come down to the number 6%. I'm not adding the state number of 3.5%, but you can add it all the years. So that means, in simple words, they're virtually halved, or they've gone back to way pre-COVID levels. That's a huge positive. So the government is not taking any populist measure, and more importantly, all this money is going into capex. So that's, I think, one thing, right? Prudence on the fiscal front. Second, what's more important is forex reserves in the last couple of years has been on the way up, which means our net exports are doing well. And we are relatively more healthy on the balance of payment front. Crisis for currency is not a big deal. Third, policies, right? I have not added policies out here, but, policies, be it for manufacturing, wherein the government has single-handedly, and this didn't come out in the budget, mind you, it came out with the income tax regime for manufacturing companies being at 15, for the rest of the people being at 25, a commitment, for everything to kind of phase down. It's been a huge positive. Now, we are at par with most of the best companies in terms of lower tax rates for manufacturing. So it is becoming a manufacturing hub. Using the same thing, the amount of cash you and I would have used 5 years ago or 10 years ago. The automation of the cash using e-Aadhaar, or next step of that is using the unorganized sector and making them a lot more organized by using GST. That's helped the economy get a lot more formalized. And when something gets a lot more formalized, by default, thefts and robberies are lesser. And that's actually led to the earnings CAGR of India from 5 to 10% till 2016, 17, 18. All of a sudden to go to between 17 and 22% for the last 5 years. So when growth comes, you start looking at what is your earnings as a percentage of GDP. And that number at one time was 1.9%. I repeat, it was 1.9% when COVID hit us. That number is 5% today. Right? So PAT as a percentage of GDP has really gone up. In US, that number is twice as much. So a lot of way to go. So technically, I think the government has finally given the corporates a way to get earnings up, and that's helping growth. So that's, the big change, be it reforms or otherwise, things are working pretty much India's way in the last 5 years. Talking about the BJP manifesto. But before the BJP manifesto, I think one interesting thing has happened, which is nothing much dealing with India, but linked, I would, to to the fact that India is politically neutral to a lot of things, has been a tie-up with Russia. It was very interesting to note that though the overall volumes which we imported from the rest of the world in oil was the same, which was a high 230 million tons. Despite that, our import bill went down 16% when the average price of crude didn't really change. And that's because of the discounts we get from Urals or from Russia. And that's purely because of the relation, I guess, the Indian government has with the Russian government. Having said that, moving to your next question of elections and BJP manifesto. A colleague of ours did a very interesting exercise. He uploaded the manifesto onto ChatGPT. It partly scared me, that what's going to happen to my job in the future. But on a very serious note, what we got out was very interesting. We got the name infrastructure come up 60 times. We got the name manufacturing come up 50 times. You got the name water come up 20 times. Green, power, rail, all of them were up 10 to 12 times. Housing was up 9 times, 7 was up, defense was up 7 times. Now, then, the question he asked was, where should investments be made or what will be profitable? And obviously, the same names which were there in the manifesto came up. But are we surprised? Because, very simply put, if I had to look at what this government, and I'm just going a little forward, what this government has done for the last 10 to 11 years, they focused on capex, and that incremental capex with the government is raising in 2025 over 24 is equal to 1.6 trillion. This is exactly equal to the capex with the government spent in 2014. So can you believe, in simple maths, 2024 plus 2014 is equal to 2025's capex.
Correct.
I repeat, what they spend in fiscal 2024 and what they spent in fiscal 2014 is equal to the capex which they're spending in fiscal 2025. Right, so that's giving you the magnitude of how this government is a lot more confident in these, in these 10 to 11 years. Mind you, the overall borrowing absolute number has not gone up, in the last 2 years, which is another big positive. And themes, based on what the government is spending are pretty simple: water, rail, metro, defense, road, indirectly power, because they've said they want to increase power through the PSUs. And I think that's where capex modes will go. And that's where the investment themes also should be.
Okay, that's interesting, Vinay. Okay. So, as we anticipate post-election, how scenario may play out, what is the likelihood, of a jump in foreign flows post-election scenario? How do we expect also, the currency to move in that environment? And, from an India-specific context, I believe FII ownership is near a 10-year low at this point in time. What provides comfort to us that the ownership would return to previous peaks, if things pan out properly?
Sure. Thanks, Rakesh. 3 interesting questions. So think about it this way, right? If this manifesto were not to be told to you, and this was not an election year, would you not expect this to have come in the next year's budget? Right?
Yes.
The same words. Is there any change in the thought process which has happened? So you're not losing time for a government change to do what's happening to the country, right? But having said that, you're an Indian sitting in India. What if you were a global citizen and you knew that, the biggest election in the country is around the corner? Would you invest money or would you wait, especially because the market is close to its peak, to see that what you believe is going to happen? And that's just a quarter away. And I think that's what probably FIIs have been doing. But that also gives us a feel good of why FIIs will put their money in. And I'll give you another way of looking at it. FIIs, this is the one in blue. If you look at what inflows they had in fiscal 24, if I had to take out fiscal 21, it's been very, 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 very high. Now, can this number be repeated? I don't think so. I think it can be more than doubled, right? It cannot be repeated because that would be telling you that, the MSCI is telling you that they're increasing the weightage in India, and the FIIs have actually reduced their weightage on India over a period of 3 years, and China also. So they're playing an emerging market story. They're going underweight emerging market, and India is being one of the players in the emerging market. So they also lose money. I think soon what will happen in the world is when you start seeing, and let me go back a little bit, when you start seeing incrementally India, inch up to be giving 15% of the overall GDP of the country, of the world. And it's already gone from 10 to 9 to 5 to 3. What you will see, at 5 to 4, sorry, what you'll see them by the time they go to 3, people will wonder why is the profit contribution only 1.6% of the world. And so also MSCI weightage as against incremental GDP contribution of 15%. Right, so the number is 10 times more. If a number is 10 times more, clearly somewhere in between, you'll see FII say that, yes, it's going to happen. Let's increase our value in the country, right? Our ownership in the country. So that's a huge positive. Having said that, moving to the next part, today you got domestic sticky money as well, be it a SIP or be it PPF, EPF or NPS. So that's the domestic sticky $2 billion on a monthly basis, which is also further value adding it. The icing on the cake is JP Morgan, EM, as well as Reuters talking about adding India in their emerging market bond index. That inflows also will come in. So things look pretty interesting for inflows. Now, the problem with inflows is just one, and I'm going to one of the slides, is what happens to the Forex reserves when inflows come in?
Right.
What happens when Forex inflows come in? Forex goes up. When Forex goes up, what happens to the dollar? Or the dollar rupee parity? The rupee gets stronger. And then what happens to exports? So, thank God I'm not an economist, but technically what happens is, you will probably see an era wherein the exporters will start seeing, wow, there's a chance of a 77, 76 rupee as compared to a 83 rupee. But for that to play off, the jigsaw puzzle is if you look at the interest rate in India at 6.5, I'm just using the repo rate, minus the US rate, which is about 5.25 to 5.5, the differential of 1 to 1.2. If I look at the 10-year interest rate of India and US, 7.1 minus 4.5, that differential of 2.6% is too narrow, right? So for interest rates for currency to come in and interest rates to go down, US also has to follow suit. Or else you may just see the currency being where it is largely, but with a lot of bias of wanting to go down because liquidity of Forex reserves in the country are going to be very, very, very high.
Okay, interesting. And we touched upon the significance now when you have domestic flows. And clearly over the last few years, they have been playing more and more of an important part in our market. How do you see this over the next few years? Do you see the momentum significantly improving from here also, increasing from here also as far as domestic flows are concerned?
So the way I would look at it is at one time, domestic SIP was $2 billion of a number. And that number, people would get confused whether it's gross and net. Today, that number on a gross basis is 2, but on a net basis is 1. And the other $1 billion is actually coming out from PPF, EPFO, and NPS, which is far more sticky than SIP. Now, both of them are adding. Somewhere else I'll take you through the ownership in India. But retail India's ownership is a substantial chunk. It's more than the mutual fund ownership in the country.
Okay.
So liquidity is clearly coming up in the country, but sticky liquidity is coming up in the country. Whether it's SIP or direct investment, I won't care. Whether it's pension funds, which I'm most bullish on in terms of volumes coming in, I won't care. Go to $3 billion a month of retail money or domestic money come in the country. We can't roll that out.
Okay.
That's really where we are.
Interesting. So then when all said and done, I mean, India, obviously in terms of the macros are very strong. We are factoring in, relatively good earnings growth. Outlook looks very positive, but markets have also now crossed all-time highs. Valuations also appear to be a little bit stretched, and the 1-year forward multiple is close to about 20 PE. Do you think we are discounting a Goldilocks scenario at this point in time?
So let me put it this way, Rakesh. Do we have an answer of how many times the index has changed in the last 5 years? Do we know an Adani Enterprise has come in and a Vedanta has gone out? So when we start seeing high PE or PE companies which don't have profitability coming and commodity stock-based PEs go out, the PE itself of the index may be 20 to 30% under assumed. And that's something which we need to digest. So very firmly, I think we should not talk about markets past performance with the future. Also, if I look at the charts, since the time Modi government has come in, you started seeing investors believe that there is stability also coming as compared to historically where the valuations were a lot more cheaper.
Okay.
So if you're telling me that, we did speak about headwinds and tailwinds, and I told you elections is the biggest, I don't know whether I wanted to call it headwind or tailwind, but it's both sides. If they go your way and you've got a very stable government which has a unanimous voting in one section, that's a tailwind. And if it goes the other way around, it's a headwind. So technically, the point I'm trying to make to you is, if stability comes in, then you'll only see this. When you see a 5-year chart, you're at 20 times multiple, but the earnings of the country have gone up. And now you're seeing stability inch up even from 15 to 17 to 17 to 21, 22% based on the government policies. Even the market, if there are no changes in the indices, will look like it's going to give you a return in line with the earnings growth. And I remember, a couple of quarters ago, we had said that, the country could be 25 and 25. Which is 25K by F25. I won't be surprised it will be 27K. In the next 12 months, which could be just between F25 and F26, right? So there is enough and more reasons to believe on an absolute basis India can make money. Yes, the discount to EM is a high number, but is EM the same EM which was there when the discount was a little lower? I don't know that. But if you see what's happened in the world, our premium over the world, I use the word discounting, it's actually premium over EM is 86%. And the premium over the world of 21%, we are much cheaper than the Magnificent Six. And that's really where you got to look at, right? What are you comparing yourself with? Growth?
Sure.
Then growth is there in the country. So I won't be too concerned on the growth element as much. And once you're good on the growth, by default, liquidity will see to it that valuations, stand up. But this is more important to be looked on a stock-on-stock basis than a sector basis, or than a country basis.
Okay, fair point. So then how should we, if we break it down further, how should we evaluate now the large versus the mid versus the small cap buckets, and especially the differences in valuations, of the three buckets at this point in time. Now, compared, if you look at last year, they had a fantastic run up, especially the mid and the small cap space. So do you think that part is losing steam now, and maybe the position should be a little bit more defensive towards the larger caps, or is there still the earnings growth remains quite attractive in the mid and small cap space, and they will continue to shine? How do you think we should position?
So let's forget this question for 30 seconds. After 30 seconds, if you don't mind. Let's look at where we are betting on growth and the BJP manifesto. So we know, what we are talking about in terms of earnings, and if you're positive on earnings, those sectors should do better than sectors where the earnings are questionable. Capital goods, a lot of leeway for the government to push. Affordable housing, construction, healthcare, even US generics now, the pricing is more or less, coming close to stability. domestic generation, domestic formulators have become FMCG names. People really value them the same way as they use them, and which is quite exhaustively. Power is the next mantra. We've seen one of the most underinvested areas is power in the country, and renewable power add to power. So there's a lot of feel good coming in out there.
Sure.
Auto components we are excited about, chemicals we're excited about more so because demand is incrementally making a Make in India company better. This is consumer services, but it's actually services like ports. You have the real estate sector, textile sector, metals, mining, utility, telecommunication. These are all, I would say, directly or indirectly companies linked to the capital goods or infrastructure sector. That number is 70% in micro cap.
Right.
And 30% or 27% in large cap.
In the large cap.
We are betting on these. They happen to be in micro cap more than mid cap, more than small cap, more than mid cap, and then finally the least in the Nifty 50. So according to that, we would also be investing in names which happen to be more in small cap than mid cap and large cap. Now going back, to the other discussion of valuation. The problem is the earnings growth in the small cap is stupendous.
Right.
If the earnings growth is good, would you buy a 17 times PE stock with a higher earnings growth or 17 times PE stock with a lower earnings? And I think the market also realized that, which is why if I compare most of the periods of time, you've seen small and mid beat the large. Longer term, that's even a more topical case. Yeah, the difference over 20 years may be just a compounding element of 2% each, but 2% over 20 years compounding is equal to like 50-60%. So technically, I think this mantra will keep on playing out because the earnings CAGR for small and mid are larger than large.
Interesting. So then, Vinay, if we try and pull all this together, what do you think over the next 2 to 3 years, the key structural themes, will provide opportunities for wealth creation? Then how should we position, or how should investors position their equity portfolios post elections now? If we take all these driving factors together.
So I think the biggest theme, may not be the most attractive theme, but the biggest theme which comes to our mind is the marriage of financials and consumptions put together. We're calling it finsumption. Theme which the second biggest theme, largely on account of the capex spend by the government, is the capex cycle. It also fits the bill with Atmanirbhar, as against buying products from other countries, make it yourself. And once you make it yourself, you start selling it to the other countries or substitute the import, which is Make in India, which is the specialty companies. So that's exactly how I would look at thematics, which we as a team in JMPMS want to play with. Having said that, we'll also use a barbell approach, about 40% in small cap, 15% in mid cap, and 40% in large cap, with a 5% cash in a hand to use it for a rainy day.
Interesting. So if I could just expand this a bit, what would be the key sectors we would be overweight on? What would we be less positive on? I noticed that in financial services, for example, we are having about a 20% position, even though the index weight is about 27%. The BSE 500, right? And clearly banks over the last few years, the balance sheets have improved, credit growth has picked up sharply, etc. This is a large and important sector. But what is that telling us? Why are we positioned like this, say, in a large sector like banks? Is it something that we are not as positive compared to some of the other sectors that you have mentioned? So how does this all tie in, basically, in terms of our outlook?
So, Rakesh, thanks for the question. So let's go by what are we consuming in the financial sector today?
Today,
it's the retail consumption which is going up. It's grown by about 30% per annum for the last couple of quarters, and that number gives you a yield. The banks of 16 to 25%. If it's coming from FI, it gives you even higher. The growth in the future is coming in from the corporates, which are giving you yields which are 8, 9, 10, 11%. Right? So your book will grow, let's say, at 16, 18%, which is very impressive. But the yields, because incremental growth will come from corporate, will probably inch down. Again, what Pooja tells us is in such a scenario, because your growth is so big and the government is, keeping on increasing what you need to keep for your risky asset risk, which you're taking, in terms of adequacy ratios or otherwise, you need more deposits into your system. And deposits, when you need more, costs go up. Now, if your yield is as it is coming down because you're buying corporate and costs are going up, you get squeezed in your NIMs. I think that's a structural pain point in the banking sector as a whole. It's just that the quality of earnings are fantastic and the stocks are relatively cheap. So that's where you go to value. How much do you want to buy a cheap stock? You're buying India, by the way, which is a growth emerging market, and you're buying it for the growth, and you're buying a cheap, low earnings company. As against that, why would you not want to buy a housing loan company, directly or indirectly, because affordable housing is being pushed? As against that, why would you not want to buy, MFIs, where post-elections you'll start seeing a lot of investments in rural India, which have been lacking in the last couple of years. So that gives you the MFI picture in a lot more clarity. Surprisingly, also exchanges, be it BSE, NSE. These are things which are much forgotten, but if India is full of people who've left their jobs and doing equity trading, options are increasing so fast, and very few ways to play increasing market share in the option market, but for companies like BSE. So lots of innovative ways, but no steady state answer.
Interesting. So if we move on now, when it took, what seems to be the major consensus bull call as far as sector is concerned, capex, industrials, make in India. Do you believe this space has played out, or are we in the early stages of a structural uptrend? So many stocks in this space have gone up 3x, 4x, 5x over the last few years. And even if we look at the flows, coming into this sector, I believe capital goods has probably been the best performing over 23 and 24 so far. Do you see, this breaking down more further where, the broader capital goods industrials, we may look more at a power, for example, or some other offshoots of manufacturing like auto, etc., could do relatively better going into this FY25? Or do you still see cap goods and industrials, there's significant steam there because genuinely there is a structural uptrend in this space?
So I would repeat what I said earlier. The Indian government is increasing the capex by F2014 in F2025. So that shows you that the steam is just crazy. You're adding a full year as an incremental growth in this year. Think about that. Having said that, we got to get case specific again. If I look at capex and I look at, let's say, water, a country which has spent 140 billion in water 10 years ago is now spending $1 trillion. That is 7 times higher. There are 4 listed stocks in the water sector. Or 3.5, because I don't think Triveni Engineering is a full-fledged stock purely in waters. And their order books are 3, 4, 5. Very strong order books. Most of them are cash flow positive. Right? So, and they are nowhere close to 20 times multiples cheaper. So, there is a company's balance sheet has improved. So there's enough of, I would say, margin of safety in water. Defense, I'm just talking about sectors which I think
Yes.
have the motto left. To keep my dear Rahul, capital goods sectors sentiments positive. I've not spoken about railway because railways growth is now seen, but after 3 years, it's getting difficult to visualize India, which has gone from 5,000 wagons per month to go to more than 12,000 wagons or 13,000 wagons. So you'll see a rate of growth probably slow down there. And the stocks have been three wagons. But sectors like defense have become consumer names. You're spending about $20 billion in India in pure defense, as against $250 billion in pure defense in US. How can there be 11 or 12 time differential when anybody can fight with anybody? This is not a PPP adjusted per capita what you're spending in defense, right? It's like to like. And I think that's where you will see a lot more investments, and that's where you'll see also the government doing a lot more Atmanirbhar, and as a result of which Indian companies will gain a lot. Having said that, earlier things were a lot more cheaper even in defense, to be fair. So that really leaves you with power. And power is played through PSUs or let's say companies like Tata Power. Now here what's important is renewable energy has a higher P because people think of them as ESG names and they become a lot more efficient, most of the energy companies, power companies. And I think utilities, just because you've not seen inflows come in, you will see a lot more inflows come to utilities, especially there are tons of cheaper names.
That's interesting. And moving on, Vinay, now, to some of the sectors that have been laggards, do you see, for example, in chemicals, a scope for revival? Like, for example, about a year and a half ago, pharma was underperforming, but it's picked up extremely well. And the outlook certainly has improved, even going into this year. Or do you see any hope also for a sector like IT, which has had a bit of a false dawn 6 months ago? But again, going by the results, things are still not over the worst. Do you see any scope for positioning the portfolio in any of these sectors?
What you're asking, Rakesh, is very interesting. You're asking between the devil and deep sea what to look at, right? At one end, one's dependence is on China. At the other end, the dependence is on US interest rates to come down.
Yes.
Right. Yes. So let's take the US angle first. We think US has clear and, I'm a big Harrison Ford fan, so apologies for that. But, you see clear and present danger in US for sure. You are seeing interest rates be a question mark. Till you don't see them fall, I don't see the IT names being good. Manjua analyst tells us that why don't we marry manufacturing sector to an IT sector and buy ER&D names, and I really like her thesis out there. And there are many good ER&D names you can play with. So that's one way to play, the IT names. But I think the normal IT names, you have some pain left in the short to medium term. China needs to increase its manufacturing. They need to get their act right faster. And here's where I think chemicals can do a little better. So though IT names are cheap, chemical names, because they can become Make in India or China plus one strategy or the Europe plus one strategy, so you will see chemical names or chemicals, fine chemicals, contract manufacturers, getting into pharmaceuticals, kind of the marriage of all of them, do a lot more better in our eyes as China opens up. So it's not that you can only play by Japan to play the China second derivative. You obviously also can play these names into the picture. And they're tomorrow's EV story. If you don't want to buy a auto onto ancillary, you definitely want to buy a chemical name, which is going to make electrolysis, right? So I would bet on chemicals as compared to IT, between the devil and deep sea.
Okay, that's a fair point, Vinay. So I think, this would be a good moment now. I'm just keeping one eye on the clock. We've done about an hour. I think we've covered a tremendous amount, in that hour. Vinay, I think I'll ask our colleague Ashu now, to invite the audience, to ask any questions. and maybe then we can, take it further from there. Ashu? Yeah. Any questions? Ashu, if you can share with us from the audience. Ashu, are you there? Any questions from the audience?
So Rakesh, I think if there are not many questions,
Yeah.
we can, because we've covered a lot of grounds.
Absolutely, I think so.
And what we just spoke about in one cheat sheet, which may help people.
Sure.
Firstly, if you look at the year 2024, now I'm talking about calendar. Earlier I was talking about fiscal. US is in a pain point, and interest rates are going to be high for long.
Okay.
The global debt has certainly ballooned, and 2024 could see a slowdown. The word, when we look at words like recession, they're big words. But between a hard landing and soft landing, would be more of the favor of soft landing.
Sure.
China is in for a tough time, and we're praying or hoping that it gets away, because you need a global. Questioning valuations, but unfortunately, small and mid caps also have the highest growth in earnings coming in. Among the tailwinds, inflation has come off. We're not at 7, 8, 9%. We're at 3, 4%. Even for India, we're at 5-ish%. India is looking really good on the economic growth. Earnings driving power is only propelling. Capex is singing. Make in India is helping manufacturing stories in a substantial way. A tie-up with Russia, has curtailed the crude oil shock to us. Now we are no longer depending on FIIs for inflows. Domestic SIP and pension funds are doing well for the country. FII ownership is at all-time low, and emerging market bond index inclusion, should include inflows coming into the country. Don't fool yourself. There are lots of risk, especially at current market prices, be it geopolitical or elections. But net and net, we are pretty bullish on an absolute basis in the next 12 months on the Indian markets.
So Vinay, I've just seen a couple of questions on the chat box. I'll just read them out very briefly. Some of the investors have asked, and I'll summarize them. One question is regarding, IMF has forecasted GDP growth at 6.8% for FY24. How would global factors affect this for India? And, would that result in an increase in inflation going ahead, if these geopolitical issues lead to higher oil prices? And a second question we've been asked, also more connected to one of the sectors, is that the railway stocks are trading at high multiples. Do you see the same growth continuing? And do you believe these multiples are justified, Vinay?
Sure. Coming to your first question, oil, I think we did answer it, but let me try taking another way of looking at it. Oil is a pain point for India. Oil is a pain point for China. Oil prices are not good, when they go up for any other part of the world, but for Middle East. Right. Geopolitical risk leads to Middle East and other places not producing as much as oil, as a result of which oil prices move up. As oil prices move up, inflation goes up. If inflation goes up, there's no question of interest rates coming down. Right. So it's all circular. So clearly, geopolitical risk will lead to oil prices moving up. India has a negative correlation, especially post 90, for oil prices as well. And that is the single biggest risk. Geopolitics leads to oil prices moving up, and that is the single biggest risk. Or else with EV, green energy, conceptually oil prices should come down, but that's not happening because supply of oil is also restricted. Moving to your second question on railways, clearly the best time to invest in railways was 2 years ago. which is why the stocks have more than tripled, since then.
Yes.
This year, which is FY25 and FY26, but most of FY25 will see north of 50% growth. Then the growth starts coming down in 26-27 substantially.
Okay.
So technically, you still have one more good year of growth. So you can now think of it as a normal compounder of 15 to 20%, for the next year or two. You got 3 good quarterly results, but I think the market will read that way in advance. So incrementally, you're going to think a little bit more on railway names than you had easy ways of betting on it earlier. If you're betting on passenger as compared to freight, because in freight, the story largely in volume expansion seems to have played out. That's the reason to be bullish, the rail companies. Again, some rail companies may have a tie-up globally with companies like Titagarh has with ABB, and the propeller systems or the braking system for Jupiter will lead to relatively some more business coming from them directly or indirectly because of global demand. And that's where we will be relatively relooking at stocks. But currently, the stocks, the compounding element of 50-60% is behind you. Now it's going to become like normal stocks to look at it based on individual opportunities.
Okay, Vinay. And the last question I've seen in the chat box, Vinay, just briefly, our views on the road sector, since we've seen an investment increase by 18 times over the last decade, as per your data, and just reading out the question, what are the companies we would prefer in this sector, if any?
So, when you look at roads as a sector as a whole, it's doing really well. Clearly, unlike power, unlike, I would say, water, unlike defense, where you can have 100% companies which are focused on that, here you've got more EPC companies coming into the picture. And you got to look at on an individual basis names which you like, which are purely road and not housing. It gets too micro for us. So for us, we currently prefer playing it where we understand the story a lot more better, where orders are coming individually and the order books are good, which is a lot more in power, in rail, in or even ports, into the picture as compared to pure road companies, which would be much smaller. I'm not getting into L&T because L&T has a little bit of virtually everything, as a company, because we think there are better niche capex stories in the rest of the space. Indirectly, if you want to play roads and you want to buy cement companies, again, that's not an uninteresting bet. That's quite an interesting bet as a secondary.
Sure. Okay. Thanks for that, Vinay. So I think we've covered all the questions that I've seen on the chat box. So I think at this point, I'll take that opportunity to thank everyone for attending the webinar. It's been a pleasure. And, both Vinay and I would look forward to, having this interaction with you again in the near future. So once again, thank you, everybody. And all the best till we meet again. Thanks.
Thank you so much. Really appreciate you joining the call from all of us at JM. Cheers.
Bye-bye.